Hello, everyone, and a very warm welcome to today's major markets update for Friday, July the 28th, 2023. It is going to be the bull versus the bear. Are we in a new bull market, or is this just a bear market bounce? As we have exceeded pretty much the upper end of what I find logical bounce target zones, somewhere around 50 to 76.4% retrace, it is definitely time to reassess the charts, and I have some really, really cool charts for you with some amazing Fibonacci overlap. On the other hand, I could also say lots of conflicting signals out there. So it's like a two-legged stool in today's presentation. But I'm going to start with the conflicting signals and why those are conditions and not triggers. They do, of course, play with our sentiment, lots of negative divergence, no market breadth, extremely bullish sentiment, but the market keeps grinding higher anyway. So in the end, it is, as Brian Shannon says, who has developed the anchored VWAP, not only on a open and closing basis, but on a multi-time frame basis. Highly recommended. That only price pays. So we only look at price. Everything else is nice. Remember, this was our primary expectation that we are in this B-wave bounce. Well, the upper end of the B-wave bounce should have ended at 45.84, and we have pretty much, of course, exceeded that by now. You know, we are close to the 4600s, right? Yesterday, I think, or the day before yesterday, or this week, whatever it was, we got all right to the 4600s. So if that's the case, I have to reassess this chart. Where is things different? So let me start then with the conflicting signals before we move on. So the first conflicting signal, for example, here is a tweet by Tom McClellan. It's not that he's wrong. He's simply pointing out the data. That's all we do. We point out the data. This is a tweet from him from yesterday. And again, he says, I always talk a lot about the difference between condition and a signal. So the NYSE McClellan 80 oscillator has been in a bearish divergence, which is a condition, and now it broke down through zero, which is the signal of Thursday's big intraday breadth reversal, as you can see. Well, what does the market do the next day? It goes up. Now, question is, did the market really go up due to the inflation data? Well, that's what the news says. It's really not true, because the market has been rallying pretty much since the futures opened yesterday afternoon till the data became available. Actually, 90% of the rally was already done before the data became available. So the data had absolutely no bearing whatsoever on the market. You can check the futures market and then you know, actually the market dropped based on data. But let that not confuse us. We stick to our data. So again, it shows us this is a conflicting signal. This was a bearish signal. We've had it before, but it might have been erased. Now we're going to look here at market breadth. Pathetic. Yesterday was negative, lots of negative divergence, only 6, and we continue to grind higher. Look at the PMO index. It's been on a sell pretty much since late July. This indicator sometimes works wonderful, just like here in October, all the way through November, right? December. Look at that. Beautiful buy signals, beautiful sell signals, and then once in a while, it just falls apart. This is why we say everything works most of the time. Right? Or as Anchorman says, 100% of the time, it works 60% of the time. Okay? Or 60% of the time, it works 100% of the time, whatever you want to make of it. And we're in a similar situation. So also this one tells us, sell signal. Yesterday, we had an additional sell signal. Again, completely ignored. We are now at a higher close. Put-call ratio is dropping. Normally, that's indicative of a top. Not this time around. So we have a lot of charts that are all pointing towards the top, but it's not happening. So that needs to be always taken into consideration with your trading and how that affects your psychology when trading. We have all this data and everything is pointing lower. What does price do? Go higher. What do we trade? Price. So that's the only thing that matters. Everything else is secondary. That's why I always say price comes first, everything else comes secondary. Market breadth secondary, sentiment tertiary, and then everything else is really low. Here we're going to look at exposure of active money managers to the market. We are now overexposed, leveraged 102%. Hasn't been this high since the November December 2021 peak. So is this a reason for concern? Well, it is. We're definitely very bullish. You know, it's pretty much of a, you know, you've got to put your money where your mouth is. But it has happened before, and sometimes even much more leverage. Sometimes it gets us very close to a top, and other times it really doesn't matter much. So again, we are overexposed. So that does beg the question, are we going to pull back? But so far the market is ignoring it, and we can always get more overexposed. So again, lots of conflicting signals, but this is a condition, as Tom McMillan always very accurately outlines, not a signal. So we have to put all these conflicting signals aside and look at price and price only. So that brings me to the second slide. Oh, sorry, last part I want to look at is technical indicators. Lots of negative divergence. RSI5 is weakening. MACD is weakening, right? It's all weakening. I haven't even added money flow. Let's have a look at money flow, for example. Money flow is, of course, also important. How are we doing on money flow? Should have added it first. It's also weakening, as you can see, right? So this is all weakening, but price is still moving higher. You see here, we're going higher on less money. But again, it's a condition, not a trigger. So we have now a new uptrend closing high. Closed higher than yesterday. And again, one day doesn't make a summer, or in this case, a winter. Right? A down day doesn't mean anything. You need to see follow-up. And today was definitely zero follow-up on yesterday. We did not break below 45.25. That was the line in the sand, and we did not break below it. We got to 45.28, close but no cigar. Also, we were tracking 5 waves lower. We did not get 5 waves lower. So, also there, close but no cigar. This is then the bigger picture Elliott wave count I've been tracking as my preferred wave count with a completed impulse since the 2020 low. Now, B wave tends to top in this zone here in blue. The upper end is 76.4. The lower end is, I believe, 50%. That's where we normally top. We've now exceeded it. Okay, we're getting close to where the B wave potentially becomes irregular. If the B wave becomes irregular, like we saw here in 2020, we do need to back the question, is this wave count correct? Okay, it does look really correct. I can count it this way, with a caveat that this wave 3 here is a little ugly. All right, it's kind of overlappingly ugly. So, reassessing the charts with my snotty, congested, headaching brain, I have been reassessing the charts today, and I can come up with something very interesting. Okay, so we have our wave 4 low here, then we have the wave 1 high here, not all the way here, but here, 1, 2, 1, 2, another 1, 2, another 1, 2, and now we're wrapping up all the 3s and the 4s. Normally the third wave tops at 161.8. That's fine. Here we topped at 176.4. Normally the fifth wave goes to 200%, 5,034.24. Write that number down, 5,034.24, right? Big, bold letters. Then normally the fourth wave, normally, right? Market doesn't owe us anything. As long as wave 4 and wave 1 don't overlap, they can do whatever the heck they want to do. We have here a double zigzag lower for potential wave 4 because we have no overlap of this wave 1. I know this wave 2 here was only 2 weeks. This was a whole freaking year. Pardon my French. But if we then apply a impulse pattern higher, 1, 2, and this was an A, a B, a C of a irregular running flat wave 2, 1, 2, and then 3, 4, 5, 3, 4, 5. Look where this wave 5 of 5 is going to top. The 200% extension is the typical wave 5 target zone. The 200% extension of this wave 1 matches exactly the 200% extension of this wave 1. 5,034.24. 5,034.24. Oopsie daisies. That is something very striking. Are we going to reach it? I can't predict the future, but as long as we hold above key levels, which in this case, it's pretty much 42, 4100, and at the minimum, I would say 4400, yes, we can achieve it. Then we had a very nasty big wave 4, completely out of proportion with the wave 2. But I remember, and you might remember it as well, and I've had that issue too, is that the rally here counts best as 3 waves. Also, I know Avi Gilbert from wavetrader.net kept saying that the rally into the 2022 high from the 2020 low counted best as 3 waves, okay? The primary expectation, because we can count it as 5 waves, the primary expectation was that, okay, at least we're going to get the bounce. Well, we've now got our bounce completed. We said 4,300 to 4,650. Okay, so we're getting very, very close. 4,650 is really like the line in the sand, but anything above, I would say already 4,550 was too much. And then we have to be cognizant of the fact that, well, maybe we're still off by 1 wave degree. Okay, and this is amazing. The overlap here of this wave 5 for this wave 5 at 5,034 is amazing. If we can reach it, that'd be fantastic. So I think we're going to reach 4650s for this wave 3, a 4, a 5, a 4, and a 5. Okay, I'll show you in a minute. Shorter term, that matches quite nicely as well. The 4650 5-ish matches really, really nice. Now we're going to zoom out even more, and we're going to look at yearly candles. All right, corrective years are down years. End of story. So we're starting here in 1924. Super cycle 1, super cycle 2. No arguing about it. And I think 36 was super cycle 1. And 1942 was super cycle 2. Remember, once the Japanese attacked Pearl Harbor, it didn't take so long for the market to figure out who's going to be the winner. The decisive winner was, of course, the United States and not Germany, or the Allied forces, to be more correct. And yes, the market rallied 150% during the darkest time in the world of World War II. Once World War II completed, it didn't take long for the market to realize, okay, well, we're probably going to contract a little bit. We got our primary 2. And then we simply count down years as corrective years. 13 makes an impulse, all right? Primary 3, primary 4. If the absolute wave counts might not be correct, this is a very objective way of wave counting. Then we had another impulse, 9 waves higher to 2000, A, B, C, lower for this cycle 4, and now we're counting another 9 waves higher. This year here was essentially down year. 1, 2, 3, 4, 5, 6, 7, 8. I need to see an impulse. I don't care about the wicks. I only care about closing prices. It's a very elegant, simple method that works 9 out of 10 times. So we need to see one more move higher. I'll show you several other indexes. The NASDAQ and the semiconductors also suggest we need to see higher. I haven't seen negative divergence yet on the yearly RSI 14, which would be great, for example, here, and we need to see it. No negative divergence yet, like in 2007 and the 70s. 50% correction. This was a 60% correction. So max strength is normally also at the third of a third wave, which was the 2000 top at cycle 3. So we might indeed have this one last major 5, primary 5 left to complete cycle 5 of super cycle 3, okay? And we know the cutoff levels. If we drop below 45.25, first sign that we're going to go lower. We drop below 42, 4100, top is it, all right? But that's a long way to go before we get there. Then, of course, we have to deal with time cycles. I've pointed this one out before. We have massive overlap here, early 2024. I've showed you that before. It doesn't have to match exactly, but oftentimes when we get this nice match of larger and shorter time cycles, we're getting very close to an important top, okay? We saw it here in 2007, we topped in 2007. We saw it here, 2011, topped in 2011, 2015, 2019, got very close to 2020, and getting there. So also time cycle wise, it suggests we have time left to finish up these final waves. And then of course the oil Dow Jones relationship, we should still be in a bullish phase going into September, October this year. Potentially all the way into middle of next year, because this is relative, this is not absolute, okay? This is the same as seasonality. It's about the direction, it's not about the exact amplitude of the move. All right, so we got that out of the way. That's the big picture. Okay, so we had our primary expectation again that we had indeed 5 waves higher complete at the 176.4% extension. It's absolutely acceptable for a wave 5. I have some reservations on this wave 3. It's a little too overlapping, so I can argue as this being a leading diagonal wave 1. Okay, no overlap with this wave 1, and again, amazing Fibonacci extension matches between intermediate 5 and major 5. So that brings me to the shorter time frame. How are we going to deal with the short-term mess that we're in? The short term is oftentimes, of course, more difficult to elucidate than the longer time frame, and it's an absolute mess. Yesterday, we did not break below 45.25. We got 45.28, and we're now back to where we came from. And all I can count on the hourly time frame are 3 waves lower. All right, so we got 3 waves lower. This means this expanding diagonal, which originally we thought was a ending diagonal, might have been turned into a leading diagonal. Remember, the market always keeps its options open. By ending the day with only 3 waves down, it could decide overnight to make it into 5 or 3. So far, it looks like it decided to only make it 3. That means we might see an extension. How this extension is going to unfold exactly, I don't know. But we have an upside target here of 46.48. 46.48 matches, let's see here, quite nicely here with 46.53, right? We have a nice Fibonacci overlap there. So that matches really nice. So that's what I'm going to look for. We can potentially extend all the way to 46.80, 46.90 if we see a standard impulse pattern. Again, the cutoff remains 45.25. We got indeed our first warning yesterday. That was the first warning, but the warning was not followed up today at least. So another way then to look at this is that we had, instead of an expanding leading diagonal, which is a way to interpret this price data reasonably well, as a simple A, a B, and a C wave lower of a regular flat type of correction. And we're now 1, 2, 3, 4, 5 in our way higher to this 46.50, 46.90 level. A break above, of course, 46.07 will confirm 46.50, 46.90. Okay, so again, unfortunately, due to the rather trendless nature of the price data since July 19, this is just a sideways sloppy mess. It's very sloppy, it's hard to interpret. We can also interpret this price action indeed as an irregular flat wave 4. It's all a bit ambiguous. So we have to go by price levels. Once we break out, we know where we're going to head. Once we break down, we know where we're going to head. Okay. And then last but not least, this is of course the other option that we have topped, but that requires the break below 45.25. Okay, this is the alternative. So then we have indeed topped. I have to see over the next couple of days what's going to happen. I can't say with certainty. I do like higher prices based on the NASDAQ, the Dow Jones, as well as the semiconductors. Okay, higher prices, I believe, is now most likely because we did not get the 5 waves lower and we did not go below 45.25. The bears missed it by 3 points. Sorry, close but no cigar. That's just the way the market is. Don't like it, put your money in the bank account, never deal with the markets again. If you do like it, then here is the NASDAQ 100 chart. And wave 3, it should have topped here. Well, we got very, very close on a closing basis, picture perfect. Wave 4 should have bottomed here. We went a little bit below it. It's fine. If we have a little bit of an overshoot to the upside, we might see a little bit of undershoot to the downside or overshoot to the downside, however you want to say it. And this wave 5 target zone here, it's at 16,110, 115 remains open. I think we can target it. Again, we broke above yesterday's open, so this is bullish. The Bollinger Bands still look bullish. We're above the 10, the 20, the 50, the 5-day simple moving average. So far, we're still following a reasonable, well, impulse pattern. And then wave 4 completed yesterday. I would say also here as some sort of flattish type correction, whatever you want to call it. We have an A, a B, and a C with the rally into yesterday's high as 3 waves, A, B, C. loud and clear. I'll show you that in a minute. And then I think we can still target 16,115 for this wave 3. We get the 4 and the 5 for a larger 3, 4 and a 5. Okay, which then matches, of course, with this 3, 4, 3, 4, 5. Okay, 3, 4, 3, 4, 5. That means also from a regular NASDAQ perspective that looks almost cleaner. Have this wave 4, and we're going to get the wave 5 to about, I would say, 15,000. Looking at the yearly candles, this is a log scale. The log scale makes sure that we count the waves on the smaller numbers earlier here better. Otherwise, this is pretty much a flat line and only the larger prices show. Then we have primary 1 here in 2000, primary 2 here, I believe, in 2002, and then 1, 2, because remember, technology did not make a lower low during the 08-09 crash, okay, compared to the S&P 500 and Dow Jones. 1, 2, 3, 4, 3, 4, 5. We still need a wave 5. And the correction into 2022 was a nice, exact 38.2% retrace of the entire primary 3. Okay, we had 1, 2, 3, 4, 5 waves up into 2021. 22 is then primary 4, 38.2% retrace. And now we need one more primary 5. That will then give us also massive negative divergence on the yearly RSI 5 or the yearly RSI 14, whatever RSI you want to use, to usher in a much bigger correction. Okay, so this matches really nice. So this one also suggests that we might look at 5,034.24 for the S&P 500. Okay, shorter term, this is then how we would interpret the price action. That yesterday's low was indeed C of 4, and we're now in 5 of 3. 1605 is the ideal upside target. Again, matches very nicely with the 200% here, about 1610. I like it. Seems like inevitable destiny. This shows you how complicated fourth wave corrections can be. This is my best interpretation. Very whipsawy. Definitely cost me money this week. I must admit, it wasn't a good week for me in my trading. I lost money. I learned 2 lessons. Don't trade when you're sick, and don't trade fourth waves. They're just too messy, but it's fine. The overall bigger trend for me is up. So I don't really bother about losing trades. I just got them short and then re-enter again. Anyway, we have not broken below 15,275. So this is still the preferred wave count. This matches, of course, with here just a 1 degree higher, 1, 2, 3, 4, 5 in green versus 1, 2, 3, 4, 5 in gray. It's all good. Potato, potato, you get the same upside target. The alternative remains that we have some more complex price action to go that we topped already. Okay, it is possible, but again, we were looking for 3, 4, and 5. Didn't get it. I can't count it on the hourly time frame, and this just looks ugly. Again, at the minimum below 15,375 to start to suggest that we have topped indeed. Semiconductors. Well, the semiconductors, the preferred wave count was for a B wave because of the overlapping nature of the price section that we had 1, 2, 3. That's normally then reserved for an ABC once we overlap with wave 1. We clearly did it. The only option then left is that if 4 and 1 overlap instead of a diagonal. And it seems like we're dealing with a diagonal because we made a uptrend high. I would still like to see higher prices. Okay, at last, an expanding diagonal has been confirmed. I couldn't care so much about it. This is a really classic example of how ugly diagonals can be. Once we have overlap with 4 and 1, okay, the potential 4 and potential 1, I prefer to just count it as an ABC. That is the preferred wave count because diagonals are so unreliable. And I think this price action we've seen here since, I would say, July 20th or even maybe July 19th just goes to show how unreliable gapping and messy this price action is. It's very hard to trade on a shorter time frame. This is really a, hold your bleeding nose type of price action. So then we have this expanding ending diagonal with a target of about 39.60. Also here, we have now a higher closing price. Bollinger Bands are expanding again. Again, lots of negative divergence. Look at this MACD. This looks really ugly, but price is the final arbiter. not the MACD. And sometimes the MACD doesn't work. It worked great here. It doesn't work so well here. It happens. Okay, nothing works all the time. If we realize that and are peace with it, then we can move on. If we get hung up about this, the MACD doesn't work, then I'm going to use the RSI5. Well, it's not working either. I'm going to use the full stochastic oscillator. Dude, it's not working either. It won't work all the time. All right, don't chase ghosts. The only thing that works is price. So this looks still bullish. We're at the upper Bollinger Band. You can see it's expanding. You zoom in. So the next upside target is about 39.60. On a yearly time frame, also the semiconductors needs a higher high for a 5 of 3. Semiconductors appear, in my humble opinion, in a different wave count than all the other indexes, but that's because it's a different index. Completely different, of course, than the Dow Jones. So that one is also looking for new highs. So then we're going to look for 3. Of course, always the potential for a B wave, question mark, but that's why we labeled it as with A/4. A1, B2, C3. We remain objective till proven otherwise, right? We have to remain objective. Not until we see 4 and 5 do we know that it was indeed 5 or higher. I cannot forecast the future. I just simply track it. But based on this price action on a yearly basis, I would suggest that it's the primary expectation. All right. Last but not least, Dow Jones. Well, we've topped into our ideal 3 of 3 target zone. We reached the upper end of our ideal wave 4 target zone. I would have liked to see a little bit lower, 3,500. Still reach it if this is an A, a B, and then a C wave low, a full 4. I still expect a 5, a 4, and a 5. Why? Also here, as you can see, we have fantastic Fibonacci overlap between the 200% and 161.8% for this wave 3. So then here we have, again, A/4. It's been on the map or chart forever. A1, B2, C3. We don't know yet, okay? If we're going to make new uptrend highs, then we know that this was wave 4, 1, 2, and this is then 3. And we're going to get a 4, we're going to get a 3, a 4, and a 5. Then we have a much longer bull market to go. It matches quite well, of course, with a larger turning date somewhere early next year, somewhere around March next year. So that's really all I have for today. So Dow Jones still nicely on track. There's no question about this one until we break below 34,600. If that's the case, then reassess the charts. All right. So I think we have some really nice charts here. We have a lot of conflicting signals from the market breadth sentiment, indicators, technical indicators. The price is completely ignoring it because price is the only one that pays. So we have to put these ones aside. And then we had our primary expectation of a B wave that now is being questioned because we're starting to move beyond typical Fibonacci extensions for the B wave or retraces, however you want to look at it. And then we found fantastic Fibonacci overlap. I can't say we get there, but oftentimes when we have such fantastic Fibonacci overlap to exactly to the cent, it often means the market has a goal to get there. This would fit once again also with Avi Gilbert's work. So I think there is a lot of merit on this one. And as long as we hold these key levels, the first one is 45.25, the second one is 4,100, 4,200. This pattern can really evolve and develop. That means that our original anticipated B wave bounce thesis was wrong, but we got the direction right. We were looking for 4,300, 4,650. So we've reached it. And it's always never a bad idea to become cautious. When the market starts extending, you start realizing, okay, where was I wrong? Because we were wrong to prove it right. That's just the way it is. But I think we've captured this very nicely. Shorter term price action is all over the map. It's much harder to elucidate. Yesterday's price action super bearish. Today seems like completely erased. And I still think we should look for higher prices unless we break below these key initial levels, 45.25 for the S&P 500. The Nasdaq 100 needs to break below yesterday's low. It's about 15,390. Okay, the Dow Jones needs to break also below yesterday's low at about 35,250 to suggest that we have a larger correction on our heads. That's all for today. Thank you so much for listening. Excuse my nasal voice, but I am slowly getting better, and I hope to be in better shape next week. Take care, trade safe, and I'll see you all next week. Bye.